So if you've made the wrong call, unfortunately, things can go very wrong. How do you pick yourself up? And have there been instances where you've done that? How have you done it?
Yeah, I think there are two kinds of mistake. One is, of course, you buy the wrong stock itself. But let me give you an example of one stock that I got wrong. We bought a company called MTNL, if you may recall. That was the fixed line provider, public sector stock in India. That stock went from, I don't know, 200 to 20 bucks or so. So I lost 90% of my money in that stock out there. But the thing is, there's a quote attributable to Peter Lynch, where he says that you should always water your flowers and cut your weeds. So while I lost 90% of my money, it was a loss I could avoid because I had 10x, 20x in so many other stocks. So I lost one part of my earnings in MTNL, but it more than made up by other stocks that went up 10, 20x. If you flip everything for 20 buck profit or 20% profit, you're never going to get rich. So Buffett also taught Lynch and taught us that you have to hold on to the great winners forever because compounding will take you over time. But the other set of mistake, which Buffett calls thumb sucking, which are so important that I think value investors broadly will get this part right. So, we'll buy good stocks, and even if you have a few losers, the winners will compensate for the losers. So there's nothing I worry about too much. But it's what we call not the errors of commission, it's the error of omission. I mean, for example, Bajaj Finance, the company in my backyard that, in Pune, I mean, it's in my circle of competences in finance. And for many years, I missed that. I mean, that's an error of commission, error of omission. Because how can you miss that? It's in your backyard, it's a business you understand, it's run by management you trust, how you do that. Again, I'm not recommending any of these stocks, but just to illustrate the point that these errors of commission, errors of omission that you make sometimes hurt your portfolio more. I think no one can point out, say, oh, you didn't buy this, or you didn't buy that. I think that's what we should try and, if there's something within your circle of competence and certain something that you should understand, and if you didn't understand that, you should really punish yourself. And I think that's something that I think we all could improve, including Warren himself.
Okay, so a couple more things that would be very beneficial to people listening in, right? Warren Buffett has over the years had concentrated portfolios. So I think the question a lot of investors ask at the start is, how many businesses should you own? Is it okay to have very concentrated bets? What's the definition, in your opinion, of a concentrated bet?
I think, yes, Warren Buffett does believe in that. Charlie Munger does believe in that. Unfortunately, I'm not that good a practitioner of what Warren and Jai said. I run a more diversified portfolio, though I would say 50% is in the top 10, 15 holdings. The rest is whitetail because that's just the way I operate. I think it requires a lot of self-confidence and a lot of seasoning before you reach there. It's a goal you want to reach there, but it's not easy to reach there. So Warren Buffett has run a very concentrated portfolio. I think for most people, maybe you start off with diversified and then gradually move up the ladder.
Okay. Now, we've spoken a lot about which companies to buy, and you've said weed out the ones that don't work, right? And of course, margin of safety is something that Warren Buffett always speaks about when he invests in companies. But when do you sell is the question that a lot of people ask. Of course, you can aspire to hold forever, but if it's not doing well, how do you decide when to pluck the weed?
Well, if it's not doing well, then it's very easy. Then you know how to pluck the weed you want to do out there. But sometimes you have extraordinary winners in your portfolio because stock got up 30x, 50x. So you don't know when to sell. And there are very, very few businesses that you can hold through the business cycle. I think Munger was one person, Phil Fisher was one person who understood that they could hold the stock they bought. For example, Munger talked about a stock called Maotai, which is one of the Chinese famous liquor maker from China. And he's often told it was founded by Li Liu. And he said, we're going to hold this stock forever because, liquor is never going to go out of fashion and Maotai is going to be the most iconic brand out there. So they kind of find these businesses that they want to hold forever. So maybe a liquor business, a tobacco business, even in India, are businesses that you can hold forever. But the short answer to your question is that I bought a lot of stocks that have done very well in a bull market, up 20x, 30x in a bull market. So if you believe that the bull market is coming to an end, sometimes it pays heed to take some money off the table and sell those winners and wait for a better investment opportunity in maybe other stocks or maybe in the same stock but at a different time. So occasionally the market will take and overvalue these stocks. And as an analyst, it is your job to be true to yourself and not say, oh, because I picked a 30x, I won't ever sell it. At least I have not reached the state to buy that businesses that I can hold those 5 businesses forever. Not that there aren't businesses like that, but it takes a huge amount of intellectual rigor to figure them out. So if you do a bit more loose, elastic analysis, maybe one way, if it doesn't work, obviously you want to get out of that. If your thesis is wrong, the faster you get out of it, the better. The other thesis, if you think the bull market is ending, because typically, Alex, when a bull market ends, all stocks will be down 30, 50, 70%. So might as well lighten up at that point. So that's what I use for myself.